Afternoon, everybody, and thank you so much for joining us again for another session in our concurrent sessions. If you do not know who I am, my name is Lester Kivet, and I'm hosting here with Sanesh Albert. Our next presentation, in fact, dovetails with our previous conversation. Johan EYBERS will be guiding us through his paper titled Modeling Bank Runs, an Agent-Based Approach. Sanesh?
Thanks, Lester. Our speaker Johan will begin by providing us with a historical overview of bank runs. We will journey through time, starting from the Great Depression and progressing through to the global financial crisis and the post-pandemic period. During this journey, we'll highlight key characteristics and the changes that have occurred over time.
Jan will also explore some of the theoretical framework, which is crucial for understanding the mechanics behind bank runs and their far-reaching implications, and will also provide you with a broader perspective on the various approaches on modeling bank runs.
And then where I think, Johan, it'll get quite technical, so I'm very interested in this, where you will expand on the framework by utilizing agent-based modeling to develop innovative models for a deeper understanding of bank runs. This approach allows us to capture the complexity of real-world scenarios, including contagion effects, herd behavior, and feedback loops at the systemic level.
And as particular as our previous session set up, I'm looking forward to this conversation and this presentation. So without further ado, over to you, Johan EYBERS. Good day.
Thank you. Good afternoon, ladies and gentlemen. Have you ever concerned or considered the safety of your hard-earned money deposited in your bank account? Well, if you were in the previous session, you might be starting to think about it now. But most of us take it for granted. But what would you do if you read a news article that says your bank has made a huge loss and its solvency comes into question? Well, you would go into your banking app and withdraw your money. That would be the rational behavior. But let's consider another scenario. Let's say your bank is healthy and solvent, but for some reason, people are fearful and withdrawing their money. Well, that might be irrational behavior, but if enough people do it, it would be rational for you to also withdraw your money, because any bank will fail if enough people withdraw. And that is the nature of bank runs, a combination of economic factors and human behavior. My name is Johan EYBERS. I'm a quantitative analyst at EY, and today we will be looking at modeling bank runs using an agent-based approach. This is part of an ongoing PhD thesis. So we'll start off with a brief overview of the history of bank runs. We'll then introduce the influential Diamond-Diffbiff model, then look at other models found in literature. We'll then dive into the interesting world of agent-based modeling, and then I'll show you two implementations of bank runs using ABMs. And then lastly, we'll end with a discussion on the impact of deposit holder insurance. But first, what is a bank run? Well, as the name suggests, it's when people run to the bank to withdraw their money out of fear of the solvency of the bank. Now, before the internet, that used to be the case of people running to the bank. But now you simply go into your app and withdraw your money. But why do bank runs occur? Well, the reason lies in the core business model of a bank. Here we have an example of a core business model of a typical bank. We have savers, the depositors, and we have borrowers that which the bank borrows money to. In this example, we see the depositors depositing 100 Rand, for example. The bank takes that 100 Rand, keeps 20 Rand in cash, and the rest it lends to the lenders. You see the depositors for 1 year, so it's a shorter duration, gives a 5% interest rate, and then the bank that lent that 80 Rand, it needs to earn a high interest rate to be profitable. It charges 10%, and we see the difference between the 5 Rand it pays to depositors and the 8 Rand it earns from the borrowers. That gives you a net interest income of 3 Rand. So the bank is profitable. All seems well. But what would happen if the borrowers defaulted on their loans? What would happen if the depositors withdrew more than the 20 Rand the bank kept in cash? So the core business model of a bank can be summed up with the words maturity transformation. Now that's the mismatch between the duration or the maturity of the deposits and the loans. And banks deliberately mismatch these to get that interest rate differential and to make profit. But this is also the source of the systemic or intrinsic risk in the banking system. And this is different to life insurance companies where you typically want to immunize your assets and liabilities. You try to match the durations. Well, banking, we mismatch deliberately to make a profit. Now let's look at the history of bank runs. Well, banks have existed in one shape or form since the invention of money in Mesopotamia. But modern banking, as we know it, only really started in the early modern period in Europe. And by modern banking, I mean fractional reserve banking, where a bank takes deposits, it keeps a fraction thereof in cash, and the rest it lends out. So we start our tour in the 1650s in Sweden. Back in those days, the currency of Sweden was these giant 20-kilogram copper tablets. You can just imagine how difficult it would have been to transact using these giant copper tablets. And along came an entrepreneur called JOHAN. Now, we share a first name, but that's where the relation stops, which is a good thing, as you'll see later. And he had a bright idea of starting a loan and exchange bank where people can deposit these giant copper tablets and he'll exchange them a certificate, which they can then use to transact. And it was very popular, people enjoyed it, and he accumulated a lot of deposits. He then took the next natural step and started to lend these deposits out. And all was fine and well, it was a profitable enterprise. But then suddenly, the king of Sweden, Gustav X, died. And the new council of the king decided to change the currency of Sweden. They made smaller coins, which are easier to use, and were made from a lower quality copper. That meant the copper deposit at the bank was more worth in its copper value than the denomination on the currency. So this is an obvious arbitrage opportunity, and people approached the bank to withdraw their money. Then he had his second bright idea, and that was to issue certificates which were not backed by a specific deposit, but just by any deposit. So when people approached the bank to withdraw, he would persuade them not to withdraw and give them free money. So now they can come back at a later stage and withdraw more. And people loved this, who would say no to free money. But as you can guess, he printed too much and inflation occurred in the economy to such an extent that again, there was an arbitrage opportunity where it would make more sense to go and withdraw your copper tablets with the certificates. And that started to happen, and the bank ultimately collapsed, and the Swedish economy was plunged into a deep, long depression. And as penalty, he was sentenced to death, but luckily, at the last minute, he received a pardon. And that bank was then recapitalized by the state, and today it's called the Riksbank, and it's still the central bank of Sweden. Now we move on to the 1850s. The Californian gold rush was occurring, the railway networks were expanding, there was little to no regulation. There was a dramatic increase in asset value, and that bubble ultimately popped. And then the news spread from town to town, and banks folded one after the other. An interesting occurrence during that period is towns which had telegram connections experienced bank runs sooner than those without it. So information spread. You could see the spread. Then we move on to the Great Depression in the 1930s. So after the roaring 20s, the stock market crashed, confidence in the financial system was shattered, and even stable, healthy banks failed. Out of fear, people withdrew their money. This continued until 1933, when President Roosevelt enacted the banking holiday. And the banking holiday led to all banks being closed for a period of 3 days while Congress sat together to pass new laws. One of the laws was the Glass-Steagall Act, which limited the type of transactions banks can enter into, or which type of assets they can invest in. And one thing was the separation of investment banking and commercial banking. A second thing it introduced was deposit holder insurance to instill confidence in this financial system, so people would not withdraw their money out of fear, but know that it is insured. Even if the bank fails, the Federal Deposit Insurance Scheme will cover. Now we move on to closer to home. In the early 2000s, we saw the small bank crisis in South Africa. In January 2002, an article leaked speculating about the possible demise of Sambo Bank. It had a large exposure to the lower and middle income class. We were again at the top of the credit cycle. And 5 weeks later, over R1 billion of deposits were withdrawn and the bank was liquidated. That spread to other small banks with similar exposures. And at the end of 2003, over half of the banks in South Africa had deregistered, but it accounted for only about 10% of the financial system. Now we move on to the global financial crisis. I'm sure most of you have seen the Big Short, the movie. The housing bubble popped, Lehman Brothers failed. A notable bank run was Northern Rock in the UK. Government had to step in and bail out the banks, and they passed new legislation. One of that was the Dodd-Frank Act, which actually reintroduced some of the legislation the Glass-Steagall Act introduced, but the Glass-Steagall Act was repealed in the late 90s. And then we move on to the 2010s, the Eurozone crisis, which was actually a spillover effect of the global financial crisis. The so-called PIGS countries, Portugal, Italy, Ireland, Greece, and Spain, had massive deficits, and the banks in those countries had large exposures to the sovereigns. So bank runs occurred in these countries. The governments imposed capital controls, limiting the amount of withdrawals you can make to try and stem the flow. But ultimately, the ECB, the European Central Bank, had to bail out these nations. And lastly, we move to the post-COVID era. As if you saw the previous session about the collapse of ECB, interest rates were rising, they didn't manage that risk properly, they suffered losses, and they had a very concentrated deposit holder base, which led to a massive withdrawal of deposits. So now we've seen how bank runs have occurred over history, and we see that interplay between fee and deposit holders and the credit losses banks experience. And this was encapsulated in the Diamond-Digby model of bank runs, which was published in 1983. And in this model, we have patient and impatient deposit holders, and banks have a choice between liquid assets and illiquid assets. This is a 3-time-step model, so you have time 0, 1, and 2. The patient deposit holders require liquidity at time 1, and the impatient ones at time 1, and the patient ones at time 2. The patient ones require, let's say, a return of X percentage, and then the impatient ones require a return above X percentage to reward them for their patience. On the asset side, your liquid assets, the bank can sell without any haircuts. Let's say it gets a Y percentage return. And then we have the illiquid assets, which should yield a higher returns for the bank to make a profit, let's say something greater than Y%. When the bank is forced to sell these assets, there's likely a haircut applicable, and the bank could make losses when it's forced to sell assets. And then we have random shocks, where deposit holders will withdraw their money at time 1, regardless of their liquidity preference. And if enough deposit holders withdraw, the bank will be forced to liquidate assets, and the bank's solvency can come into question. More people will withdraw, and you get into the feedback loop, and the bank will fail. In their paper, they proposed that deposit holder insurance is a solution to this. Their original paper was very theoretical. It wasn't parameterized. There was no analytics behind it. It was more philosophical. But subsequent models found in literature are largely based on the Diamond-Digby model. So let's look at some of these found in literature. The first one is the multiple equilibrium model. This essentially parameterized the Diamond-Digby model to see what equilibriums we get depending on what return impatient or patient deposit holders need, or what return you earn on your long-term, short-term assets, and so forth. Next, we have Markov models, which is a traditional state-space models. You have differential equations describing how banks flow from one state to another, and you'll have certain input parameters into those differential equations, like cash withdrawals or credit losses and so forth. Next, we see a continuous time model. Here, the assets of the bank were modeled using a geometric Brownian motion, and then the deposit holders have staggered times at which they decide to roll over or not roll over their deposits. Then mean field games of timing. This borrows concepts from mean field theory in physics, with a combination of game theory. In this model, deposit holders choose a time at which they exit the bank, withdraw the deposits, and their actions are influenced by the group behavior. Then we have panic bank runs, which is actually an experimentation done in Spain in 2018. They had 150 participants playing a computer game based on the Diamond Diffie model, and people would stand in a line essentially on the computer simulation and decide whether they want to withdraw their money or not, and they can observe the deposit holders' behaviors of those in front of them in the queue. In their scenario, banks were never under stress, always healthy and stable. No one lost money through the bank failing, but people still withdrew money if enough people in front of them withdraw. So they kind of show that banks can fail even if they are healthy and stable, if enough fear is spreading through the system. And then lastly, dynamic bank runs, which is an agent-based approach. And this was an agent-based implementation of the Diamond Diffie model. And they found if the required return for inpatient deposit holders is below a certain threshold, bank runs tend to zero, and market concentration is less than in other cases. Now let's look at agent-based modeling. I think if it's possible, let's launch the poll, and you can go onto the app and vote, and you can decide between A, B, C, or D to gauge your familiarity with ABMs. Could have added an extra option. I have a colleague that can't stop speaking about ABMs for my co-workers, but let's see how comfortable people are. Hope people are managing to find it. I'm getting some nods.
Modeling bank runs, and if you click on that, you'll see an option for Q&A and polling, and you click on polling.
Okay, we see the vast majority of people are not familiar with ABM, so that's a good thing for this presentation. I think we can close the poll and move on. Thanks. So for those of you who are not so familiar with it, agent-based modeling essentially has three main concepts. The first is agents. Those are the individual components which the phenomena which you are trying to model comprises of. So and then the environment is the world space in which these agents operate. And then lastly, you have rules of interaction. So agents can interact with each other and with the environment. So let's say we want to model traffic. Your agents would be cars. The environment would be the road network and robots. And then your rules of interactions. So cars should have a certain following distance. That's your inter-agent rules. And then for agent environment rules, it could be when the robot is red, stop, if it's green, drive. But let's make it more tangible and look at a implementation of ABMs. So this is NetLogo. It's a programming language specifically developed for ABMs. The black rectangle square, that's the world space. In the simulation, we have 500 agents or individuals. They are on that green bar. So all of them are stacked on top of each other, so you can't see them, but once we run a simulation, you'll see the figurines. So the y-axis has no meaning, but the x-axis does. So the more right the individual moves, the more money they have. The more left they move, the less money they have. In a simulation, at time 0, which you can see from the tick counter at the top, which is set at 0. People have 100 Rand, and at the end of every day, they give 1 Rand away randomly to anyone. So they always give 1 Rand away, and they are expected to receive 1 Rand back. So there's no bias in the system. Once we press run, you'll see them spread out. And then on the graph below the black rectangle, we see the wealth distribution. So currently there's 1 bar. That means everyone has the same wealth. And then on the right, there's another chart showing the wealth held by the top 10% and the bottom 50. But let's launch another poll where you can guess what you think the limiting wealth distribution is going to be. So it could be exponential, uniform, normal, Pareto, log normal. Those are your options. Some interesting results. Usually, I see people guessing the normal or the uniform distribution. Log normal is not too weird. And a couple of exponentials. So let's we can stop the poll there and let's see what happens. Okay. Pressing setup, and then go. You can see them spreading out. Looks like a normal distribution. People cannot have less than 0 rands. It looks a bit flat now, maybe approaching uniform. Let's see what happens. We see on the right-hand side, the wealth held by the top 10% is still increasing. The bottom 50 is still decreasing. Now it doesn't look uniform. Seems like we have a tail. And it has been proven that the limiting distribution will always be exponential. So the phenomena we are seeing here actually comes from physics. When you have a gas chamber of molecules bouncing around, the distribution of kinetic energy will be a exponential distribution. It's known as the Boltzmann equations. So whenever you have a conserved quantity being exchanged, which cannot go negative in a closed system, the limiting the distribution will be exponential. And we see that the top 10% hold more wealth than the bottom 50. Now, this might lead you to think that maybe inequality is intrinsic to the economy. Well, the economy is more complex than this. But interestingly enough, if we change or extend this model where people can earn interest on their money, then we see a Pareto limiting distribution, which is the distribution we see for wealth inequality in the real world. Now, let's look at a elementary implementation of a bank run model in NetLogo. So here we have 3 banks, the 3 blue blocks. We have the depositors, the green figures, and then the links means they have a deposit at that particular bank. And we have 500 individuals again, and they have a mean income. They have an income which is normally distributed with a mean 100 and volatility 0.01. And every single day, they earn money and they spend money. And the money they earn and spend is a random sample from that same distribution. So you are expected to stay at 0. But there's obviously randomness. It's a random sample. So sometimes you'll spend more than what you earn and other way around at other times. And your balance you build up at the bank. And in this model, people have a risk tolerance or a risk aversion. So every individual has a number distributed uniformly between 0 and 100. So let's say it's 80. That means when the bank's starting reserves, when the bank's cash reserves is less than 80% of the starting reserves, you will withdraw your money out of fear for the bank's solvency. And the second way you can withdraw, if people around you, if the majority of people in a radius of 2 around you withdraw, you will also withdraw. So each person has an X and Y coordinate, and they will move around when we run the simulation. And we see all 3 banks have starting cash reserves of 100 Rand. So yeah, let's run the simulation and see what happens. When they turn orange, it means they have withdrawn their money on that particular day. The graph on the right shows the cash reserves over time. We see Bank 1 doing well, Bank 2 and 3 struggling a bit, especially Bank 3. And now we see Bank 3 getting into real trouble. Bank 2 and 1 also. Bank 3 has failed. Now it's a race between Bank 1 and 2. And we see Bank 2 won. So initially, the black line is the starting cash reserves. So only when the cash reserves are below the starting value, people will withdraw according to their own risk tolerance. People can, only the second way they withdraw, if people around them withdraw. So the green bank initially can only get withdrawals if people have friends that are withdrawing from a bank. So that's the fear spreading in the system. And if you look, should have added another line, but all three lines kind of peaked in the middle there, and subsequently all three went down. That's when systemic fear occurred. Because when people leave the red bank, they go to either the blue or the green bank. They influence the decisions of people at the healthy bank as well. This is a very rudimentary model. But let's see what happens if we were to double the starting cash reserves of banks. So in this simulation, you'll see starting cash reserves is now double, 200 Rand for every bank. And let's see if the simulation lasts as long as in the previous one. The previous one lasted for 1,500 ticks. Let's see if we can get a longer simulation. This time all three are struggling initially. And it's not looking good. And it seems like systemic fear has gripped. And now that Bank 3 is making a miraculous comeback, and the other two are struggling. And there we have it, Bank 3 has survived. And this time the simulation only lasted for 552 ticks, which is not what we expected, but if we ran the simulation 100 times on the 200 Rand starting cash reserves, it will last longer on average. So this shows the randomness of the model, the stochastic nature. And in this case, Bank 3 survived because people left the bank, and that fear spread to the other banks, even though they are healthy. And it's kind of randomness that kind of decides which bank ultimately survives. But yeah, this is a very, very elementary illustration. Let's go to something more involved. So here we have a depositor bank run model, which is the basis of my first paper. And we have a couple of parameters. It looks like a cockpit of a Boeing pilot, but it's not that complex, I promise. So we can choose the wealth distribution initially. There are different ones, and you can parameterize that. Then the demographics, you can choose how many depositors you want in the model. And there are three reasons why people withdraw. The one is the base level of withdrawals. So in this model, it's set at 10%, so that means 10% of all depositors withdraw their money and move to a new bank regardless of what is happening. That's your base level. And secondly, people can withdraw according to their own risk tolerance. So they have a utility function, which they measure whether it's better to have your money in the bank or have it under your bed. And then lastly, panic contagion. So that's when people around you withdraw, you also want to withdraw out of fear. And in this case, it's set at 40%. So in a radius of 2 around you, if more than 40% of your neighbors withdraw, you also want to withdraw. And then on the banking side, we can choose the number of banks we want in the simulation. We can set a deposit insurance threshold. The starting solvency ratio is set at 2. And then the balance sheet of the bank is quite simple. You have long-term assets and short-term assets. You can specify the interest you earn on those. And then you also have a haircut when you are forced to sell your long-term assets. And then you can specify the interest rate the bank pays to depositors and at which rate it can lend over the short term. And then finally, the liquidity or asset liability management side. So we have a target ratio of 20%. That means the bank aims to invest 80% of its deposits into long-term assets and keep 20% in cash. Then it has a trigger ratio set at 16%, which means if the cash reserve ratio is below 16, it will start to borrow in the over the short term to get back to that 20. And then we have the minimum ratio. If it goes below that 13%, the bank will start to sell its long-term assets in order to get back to the 16 or 20%. So let's see this model in action. Here we have the 8 banks, and we press run. And we'll now look at some of the outputs this model generates. So the model is paused, and the first graph at the top, we see the cash reserve ratio of each of the 8 banks, and it manages between the trigger and a target. And the minimum ratio, it never goes below that because it immediately sells its assets. So you can't see that because as soon as that is breached, it sells to get back to the trigger ratio. Then below that, we see the total deposits for each of the 8 banks. And let's move on to some other output. So the graph in the middle at the top, we see the solvency ratios for each of the 8 banks. The green line is the starting solvency at 2. Then at the bottom, we have a red line, which is equal to 1. So once the bank's solvency ratios go below that red line, it fails. And the deposit holders move to a random new bank. Below that, we see the net flows over time for each of the 8 banks. It looks very similar to a white noise process. And the final 2 graphs, we can see the withdrawals for each of the 8 banks, and the top graph, the bottom one, we see the number of depositors for each of the 8 banks. Now let's see if we can break the banking system. So we are now going to reduce the interest rate earned on long-term assets, and we're going to increase the haircut when the bank is forced to sell. So you'll see when the cursor arrives there. So currently long-term assets earn interest of 12%. We're going to move it down, I think, down to 5%, which is lower than what it pays to deposit holders. And the haircut is being increased to 20%. So that's a big loss when the bank is forced to sell. So now we'll see what happens to the banking system. I'm going to press run, and then we'll go to the middle graph to see how the solvency ratios change over time. So initially they were stable and doing well. And I'm going to speed up the model now, and we see a strong downward trend. Banks are not doing well, and there a first bank has failed. And we see that trend continue, a second one fail, a third, a fourth coming now. And that had a quite dramatic impact, as we would expect. And this will continue until 1 bank is left. And we can see the net flows becoming more volatile, as the deposit holders per bank increases. And there the simulation ends. So the purpose of this model is to quantify the impact of deposit holder insurance on the frequency and severity of bank runs. And now let's look at the likely impact of deposit holder insurance, which we see in reality. So usually the scheme works as follows. There's some threshold up until which deposit holders are protected. If they have more than that amount of money in deposit at the bank, they are unprotected. Usually the banks will pay a premium to some deposit insurance scheme, to some fund, and when the bank fails, the deposit insurance scheme will then come in and protect the depositors. There are some other methods seen globally. Some schemes are funded by taxpayers. This is a funded scheme, but you can get unfunded schemes as well, where the funding is sourced only once a bank has failed. And if you think about the reason for deposit holder insurance, it's there to enhance confidence in the banking system, and it was a solution to the Great Depression in the 30s. So it does have a positive impact, but interestingly enough, there is some research by the IMF that shows there are cases where it can increase the risk in the banking system, especially for developing economies with weak institutions. And you think about it, if the deposit insurance scheme itself is under scrutiny and it's not stable, or there's some corruption, there's a second source of fear for depositors. And then another problem with deposit holder insurance is moral hazard. And it takes place in two ways. The first is banks. They might feel less responsibility for deposit holders, but they're ultimately still incentivized not to fail because they will go out of business. But then there is more moral hazard with depositors. They might be less inclined to look at the financials of a bank or whether it's healthy or not. They know they can rely on the scheme. So you might fund more risky banks. But let's look at the implementation in South Africa. So the planned implementation of deposit holder insurance is 1 April next year. The Corporation of Deposit Insurance, CODI, has been formed, and it will operate the deposit insurance fund, and banks will pay an annual premium. The Reserve Bank said it's going to be around 20 cents per person per year, which seems quite low. I don't know who did that calculation, and it looks like it's going to be up to 100,000 rand. In the past, when banks failed, there was like an unspoken rule: the Reserve Bank will bail out people up to 100,000 rand. So it's nice to have a clear rule in place, a clear deposit insurance scheme. According to Reserve Bank, this 100,000 rand threshold covers 90% of deposits in South Africa, but only about 23% of deposits in total rand value. And in our country, we have a very low savings rate, so banks are reliant on large deposits from corporations or individuals, and these investors are usually more sophisticated, and they will pull out their money sooner than your less sophisticated depositors. So some market commentators have stated that the 100,000 rand limit is maybe too low. If a financially, systemically significant bank were to fail, the impact in the economy would be so great that you can't just only bail out people up to 100,000 rand. You would have to bail out more people. But it is a positive thing to have this system in place, and time will tell how it will ultimately operate. Before we go to questions, I want to end with the following quote by Jamie Dimon, the CEO of JP Morgan and Chase. He wrote this in an annual letter this year after the collapse of SVB. Any crisis that damages Americans' trust in their banks damages all banks. Thank you.
As always, we advise you to put up your hand if you have any questions, and then after that we'll go to what is available online. Gentlemen in the back.
Hi there. So again, I have a few questions. So the first is, how useful is this type of model for an individual bank who may not be as worried about the entire industry, but for their own liquidity risk? My second question, just given your final comment on the deposit insurance, is there a potential to rather think about deposit insurance as a percentage of total deposits rather than just the maximum amount per deposit, maybe as a means of managing that moving forward? And I guess, is there any research to show if that's an alternate solution? And then I guess, how difficult is it to update these models? Because it does seem quite complex, but say, for example, you wanted a different income per individual in the system, would that be quite a complex update, or is that something that's fairly easy to do within some assumption of independence? And then there does seem to be an assumption that this model is built on relating to perfect information. I think the final point you made at the end about the sophistication is potentially a breakdown of that assumption. But to what extent is that information brought into the model? So for example, your note on deposit insurance and the person on the street potentially resorting or having some moral hazard off the back of that. If we go to a random person in South Africa, say, I doubt they would be aware of deposit insurance. So, there is a potential, I guess, breakdown of that assumption when applied in practice.
Sure, that's a mouthful. Hopefully I can remember all of them. So for individual banks, this model is, these type of models are very new. Banks don't really model these types of risks. The aim of this model is to quantify the impact of deposit holder insurance. Banks do have liquidity models and models for the outflows of deposits, but not this type I've seen in practice. So it's a very, very new thing. And then, here are so many questions, but so I think on the assumption, so it is stylized, but you are not limited by the model, but you are limited by your information available. So agent-based models are bottom-up, so you can represent the system as faithfully as possible if you have the data. So you should have more accurate results if you have the right data and assumptions, and that's the difficult part. And a big thing to capture here is human behavior, which is not that easy, and you can make it very specific. So you can, each individual you can make different. You can make every bank different. You can specify different rules for every bank or every individual. So it's part art, part science, and yeah, that's where the trick comes into it. So so you are limited in that sense, and then I don't know if I've probably missed the other 3 questions, but you're welcome to repeat them if you want to. But the deposit insurance as a percentage. So if you think about that, so let's say it's 50%. Well, if your bank's in trouble, you're going to withdraw that other 50%. So you're not really protecting the system. People are still going to withdraw. So if you make it a round amount or like a nominal amount, then at least you know everything below that people are likely not to withdraw. But as soon as you make it a percentage, people are still incentivized to go and withdraw for that other half. And even if you withdraw, let's say you have 100 Rand and it's 50%, you withdraw 50 Rand, but now maybe only 25 Rand is protected. So it never stops. You're going to withdraw everything. So I don't think that percentage is going to work. But even if you have a nominal amount, in the US, when a bank fails and they send in the federal deposit insurance scheme to take over the bank, they do it very quietly overnight, undercover, so people are not aware of it. Even though people are protected, people are still irrational. They will still approach the bank and try to withdraw. So you can't fully remove the fear, but it does help a lot.
Right in front.
Awesome, thank you. So in the first half of the presentation, you showed the research and the different type of models that have been used to in the literature to try and model bank runs. What made you interested in agent-based models for your PhD?
So I was introduced to agent-based models in Masters at Stellenbosch. So my thesis then was building a model of the COVID-19 pandemic and seeing if we can get the same number of deaths we saw here in South Africa during the COVID period, and doing some scenario and analyses. So I kind of learned this tool, and now I have this hammer, everything looks like a nail to me. But I really do think there's some great value in agent-based models, because you're simulating from the ground up. You're truly reflecting the phenomena as is if you have the data and the correct assumptions. And normal equation-based models, you usually have to group things into homogeneous pools, but with ABMs, you can represent that heterogeneity much better. You can build a much more granular model, and it's simple to communicate. It's relatively intuitive, because you break it down to the individual components. And when you build the model and specify these rules, you don't really know what the outcome is going to be. Like with the simple economy, most of us guessed the limiting distribution incorrectly. But we understood what was happening on the granular level, and that emergent behavior, that's sometimes unintuitive. And normal equation-based models would usually try and model the emergent behavior, but the relationship between the micro and the macro isn't always one-to-one. And ABMs are very good at capturing that. So yeah, thanks.
Thank you, sir.
Hello, there we go. Thanks, Johan. I'm curious to see if you have looked at historic bank runs, and I know obviously given that it's a lot of it is very far in the past that the data is probably quite sparse. Whether you've thought about backtesting some of your models to assess, strength of predictability, or whether that's something that's on the horizon for you.
Yeah, so I've not done that, but that's definitely something I'm thinking about. So there are documented bank runs, and the information, you probably won't get access to the individual account level data, but you can get like the macro data, and you can try and make assumptions to get close to what we saw in the past. But that is a challenge, but it is something I am considering doing if it's possible. And that would help to validate the model, and then we can take it further and do scenario analyses.
Okay. Well done, and all the best. I just want to ask, on your runs, you had the banks. Were the banks also agents themselves, or were they part of the environment? And so that's the first one. And then the second one is, how much of an effect does the contagion have on the simulation? Because in real life, there are other factors outside of the actual participants that affects the model. So things like macro and microeconomics. I don't know how you have incorporated those effects, and if maybe you've also looked at like multi-scaling analysis for such problems.
So the banks were agents, and the environment was very simple. Essentially, it was just the plane. So you have a flat surface with x and y coordinates, and individuals move around, and the actions of those in a radius around them would influence the panic. So that's the only real environment. But with agent-based modeling, you can make a 3D environment depending on what phenomena you want to model. You can make it more involved, but it depends on the phenomena. And then there are other factors outside of the banking system, the economic environment, stuff like that, and you can incorporate that. You can maybe build in some features of the house price, house prices, or vehicle asset finance. You can make it as granular as you want to. You can incorporate those type of things. It might be a challenge, but theoretically, it's possible to incorporate those type of things as well. And on your last question, I didn't completely get that, but I don't think I've considered that type of technique.
Sorry, my mind's gone blank. Okay, I wanted to ask about the parameterization of the model and how that influences the runtime. So, for example, a basic input that could make it a bit more realistic is inputting a yield curve instead of just the long-term and short-term interest rate. How you sped it up a bit, like how long does this model run, and how far can you go in terms of making it realistic?
So it depends on the parameters. I can make it run into infinity if the banks are profitable. So yeah, it depends on the parameters, whether that determines the runtime. But as you saw, every single run, if you use the same parameters, you get a different outcome due to the random nature. So yeah, in some cases you can get it into infinity if it's profitable and stable. But other cases, yeah, the time to failure depends on the parameters. And in this model, there aren't new entrants into the market, so it will always fail in those cases. Because only one bank will be left at the end, in the cases where the banking system does fail. And yeah, you can definitely incorporate the yield curve monetary policy into the model. But yeah, as you add these extra layers, you are increasing the computational intensity of it. So you might need a bigger, stronger computer to run those simulations, but it shouldn't be a impediment to the model.
Okay. Johan, just one on the poll, more for comment, or maybe you can add to it if you need. So James Pierce says, to the relevance of such modeling to the individual bank question. Because of the contagion component, individual banks need to look at the whole system if they're interested in their own risk. Similar to COVID modeling, insurers had to consider at least the national spread to consider the potential impact on their own policyholders. So,
Yeah, that's very true. The banking system is very interconnected, and these risks are very correlated as well. So a failure of one bank, as we've seen in the past, can easily spill to other banks. Fear can spread like that as well. So it's very similar to a virus spreading. And yeah, with the PhD, the idea is to build 4 different models. So this is the base for the first one, where we just want to try and see what impact deposit holder insurance has on bank runs. Then secondly, the idea is to focus on the interbank market, where only banks lend to each other. And then thirdly, combining the previous 2 models. Now we have a system model where we have the banks and individual depositors interacting. And then the fourth one is inserting the reserve bank. Now you have a system-wide model of the financial system with all the major players there, and then to see how risk spread and what type of parameters can predict trouble in the system. So the idea is to get to that kind of unified model. I think that could be very valuable to regulators. And in literature, there are models that incorporate some aspects of both the interbank market and depositors, but they usually focus on one side. Very, very few models actually try and simulate the whole system. So the idea is to start with this and like building a house with a foundation and adding layers till we get to the full system. And I think it should be helpful to banks as well, especially for modeling and quantifying systemic risks. And yeah, I think the main use would be for regulators.
okay. Johan, thank you so much for a well-structured, well-presented topic. I think we wish you all the best on your PhD. I think the next time I see your poll on agent-based modeling, I'll take the second option, not the first. But I think round of applause for Johan. Thank you so much.
Very much.
Thank you.
Just a quick housekeeping and a reminder, if you'd like to pop into the chess tournament area in the exhibition hall, there's a semi-final showdown taking place. There's also, be sure to visit the exhibition hall, the Mosaic Hall, the Discovery Working Lounge, the Yasa Hub, and the Meeting Hubs. It's a new addition this year, of course. And of course, the coffee bars brought to you by Discovery, Hanovery, Mollyman, Old Mutual, RG, and SA3. Well, next up, enjoy a refreshment break. We'll see you after this.